Welcome back to Cents and Commas, where we make money make sense. And today we are talking about what a FICO score is and why your credit score is like your financial GPA. Think back to high school for a second. You remember how your GPA followed you around? It did not matter if you were funny, talented, smart, or had a good heart. When it was time to apply for something important, that GPA was one of the first numbers people looked at. Now, welcome to adulthood, because your credit score works the same way. Your credit score is basically your financial GPA. It is one of the numbers lenders use to decide if they want to trust you with money, how much money they are willing to lend you, and how expensive that money is going to be. And the crazy part is, most of us were never really taught how it works. We were just told, make sure you have good credit, but nobody explained what good credit actually means. What makes your score go up, what makes it drop, or why two people can borrow the same amount of money and end up paying totally different prices. So today, we are breaking it down in regular people language. A FICO score is a type of credit score. FICO stands for Fair Isaac Corporation, which is the company that created the scoring model. Lenders use FICO scores to help predict how likely you are to pay back borrowed money. That is really what your credit score is trying to answer. If this person borrows money, are they likely to pay it back on time? That is it. Your credit score is not your value as a person. It is not your intelligence. It is not your future. It is not your character. It is a number based on information in your credit report. And I want to say that clearly because people carry a lot of shame around credit. Maybe your score is low because you made mistakes when you were younger. Maybe you missed payments because life happened. Maybe you had medical bills, a job loss, a breakup, a family emergency, or you just did not know what you were doing yet. That does not mean you are bad with money forever. It means you need information, a plan, and consistency. Most base FICO scores range from 300 to 850. The higher your score, the better you usually look to lenders. A lower score can make lenders see you as risky. A higher score can make lenders see you as more reliable. And that can affect whether you get approved, what interest rate you get, and how much money you may have to put down. Let me give you a real-life example. Imagine two people apply for the same car loan. Same car, same dealership, same day. One person has a strong credit score, and the other person has a lower credit score. The person with stronger credit may qualify for a lower interest rate. The person with lower credit may still get approved, but they may pay way more in interest over time. So even though they bought the exact same car, one person could end up paying thousands more. That is why I call bad credit an invisible tax. It is not always obvious up front, but it shows up in interest rates, deposits, denials, and worse terms. Your credit can affect credit cards, car loans, personal loans, mortgages, apartments, and in some cases, even insurance pricing or employment-related background checks. So this number can touch a lot of areas of adult life. Now, does that mean you need to obsess over your credit score every single day? No. Please do not let this number stress you out every morning. Credit scores move. They go up, they go down. Sometimes your score changes just because your credit card balance reported before you paid it off. The goal is not to panic over every little movement. The goal is to understand the system so you can make smarter decisions. Think about your school GPA again. If you got a bad grade on one quiz, that did not mean you had to drop out, but it did mean you needed to understand what happened. Did you miss the assignment? Did you not study? Did you misunderstand the material? Did one grade weigh more than the others? Credit works the same way. If your score drops, you do not need to spiral. You need to look at what changed. Did you miss a payment? Did your credit card balance get higher? Did you apply for new credit? Did an old account close? Was there an error on your credit report? Once you know the reason, you can make a plan. Also, your credit score and your credit report are not the exact same thing. Your credit report is like the full report card. It shows the details like your accounts, payment history, balances, and credit inquiries. Your credit score is like the final grade calculated from that information. So if your credit score is the GPA, your credit report is the transcript. And that is why checking your credit report matters. You want to know what information is being used to grade you. Now, here's something a lot of people do not realize. Your income is not directly part of your FICO score. You can make a high income and still have a low credit score if your credit history is messy. You can also make a modest income and have a strong credit score if you manage credit responsibly. That said, income can still matter when you apply for credit because lenders may want to know if you can afford the payments. But your actual FICO score is based on credit behavior, not your paycheck. That is important because it means your score is not fixed. It can change. You can improve it, you can rebuild. You can learn the rules and start making the system work better for you. So let's recap. Your FICO score is a credit score that helps lenders judge how risky it may be to lend you money. Most base FICO scores range from 300 to 850. Higher scores usually help you qualify for better rates and terms. Your credit score is not your worth, but it is an important financial tool. And the better you understand it, the more power you have. In the next video, we are going to break down the actual FICO formula. We are talking about the 5 categories that make up your score, which ones matter the most, and what you should focus on first. Because once you understand the formula, credit stops feeling like a mystery. If this helped you understand credit a little better, like this video, subscribe to Cents and Commas, and comment GPA if you want to keep learning how to raise your credit score step by step. I will see you in the next video, and until then, keep building your cents and your commas.